About that all day yesterday. Countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, and we do see gains across the board, maintaining a 1.6% gain pretty much in the NASDAQ and the S&P. But you can really see the strength in the dollar as where the strength and the momentum really lies. You're seeing yields a bit higher, but really the dollar strength pervading throughout the entire complex, whether it is Japanese yen or whether it's the Aussie dollar. You are seeing a euro with a little bit of strength, but what I'm looking at right now is the yen breaking down to the weakest level going back to 1998 as we look at that policy divergence, really getting called into question with some of the traders pushing back against that and saying, okay, if you're really going to commit to this, we'll double down as well and basically sell as much as we possibly can. Joining us now with a look at the stocks moving ahead of the opening bell, here's Abigail Doolittle. Abby.
Hey, Lisa. Well, we do certainly have a strong tone for stocks this morning after a brutal week, actually 3 weeks for stocks. But here we have lots of stocks higher. And one of the top story stocks on the day, Kellogg, up 5%. This as the company is breaking into 3 publicly traded companies. The largest will be Global Snacking, followed by North American Cereal, and then PlantCo, really following a recent trend of big conglomerates going smaller. Certainly good for the investment bankers, too. Speaking of investment banks, J.P. Morgan, now these shares had been down sharply last week, nearly up 3% today. This, of course, ahead of the Fed stress test. They are expected to be the largest returner of capital to investors, roughly $18.9 billion in buybacks and dividends if all goes well. Carnival bouncing back. The travel trade has been under severe pressure, but today we have some investors dipping a toe in. And then finally, with the rebound that we're seeing in Bitcoin, technically confirmed to go above $30,000 per Bitcoin, we have Coinbase Global in a nice rally, up more than 7% on the morning, Lisa.
Abigail, thank you so much. The NASDAQ resuming its bounce back after falling more than 6% last week on the Fed 75 basis point rate hike. Joining us now for more, our own Taylor Riggs. Taylor.
Yeah, Lisa, and you're right that Friday we started to build up some of the momentum. Even though Friday was a relatively good day, it was still sort of wrapping up a week of losses, as you mentioned, coming off Wednesday's meeting. So trying to at least today build on some of that, a little bit of the momentum that we had as of Friday. You're certainly seeing technology participate. A lot of people saying you really need that as some of the heavyweights in the index to participate. You're seeing that with Apple, of course, some positive news on the iPhone sales. The stocks index last week was off about 9%. So you're starting to see some of the chip makers come back today. Certainly good news. I have to talk about Bitcoin. We know that it doesn't stop trading over the weekend. It did briefly dip below 18,000. You're starting to get a little bit of that comeback start, right? Blockchain, of course, participating in that just a little bit. I think what's interesting, and Romain hates when I do this on the close, I take a look at the equal weight index. He knows that things are really bad when I start to do that. But we've broken out the tech versus the non-tech in the equal weight. And you are starting to see some of those non-tech roll over as well. And that might actually be a sign of some of a broad-based decline, some of that full capitulation that a lot of people are looking forward to seeing before you can get a true bottoming out. So perhaps maybe actually a good sign that some of those non-tech heavyweights are also really starting to roll over as well. Maybe a bigger buying opportunity ahead. Finally here, you can see, just sort of recapping the big action on Friday, Lisa, is that tech was starting to rebound, right? But energy was really to the downside. Now today, of course, we know everything's sort of a broad-based rally, maybe some signs that if this will stick into the closing bell, that a lot can happen between now and 4 p.m.
Taylor Riggs, thank you so much. Isn't that the truth? Sticking with big tech, Tesla CEO Elon Musk speaking with Bloomberg at the Qatar Economic Forum. Take a listen.
A year from now, I think our headcount will be higher in both salary and obviously in hourly. But in the short term of the next few months, we expect to see, like I said, roughly a 10% reduction in salaried workforce, which is actually just really only a 3.5% reduction in total headcount, and not super material.
A sober and really kind of restrained Elon Musk. Ed Ludlow joining us now from San Francisco with more. Ed.
Yeah, good morning, Lisa. I mean, with his Tesla CEO Howe clarifying comments that he made in internal memos, he basically said that salaried headcount grew too fast, but he gave a really good picture, robust picture of demand for Tesla, saying that wait times are very long, demand, quote, remains extremely high, and you see Tesla stock pushing higher 5% this Tuesday morning. A really wide-ranging interview with the macro backdrop, Musk saying that a recession is inevitable at some point, in his opinion. Whether a recession or not happens in the near term, he said, is more likely than not. The other big topic, of course, was his deal to buy Twitter at $54.20 a share. He says there's, quote, still a few unresolved matters. The proportion of users on the platform that are bots, whether they are less than 5%, as Twitter says, being the main sticking point. He's awaiting further details and clarification on that. Although what was really interesting is, once again, with such a forum, such an opportunity, he did not explicitly state that he intends to proceed with the bid, $54.20 a share, although Twitter shares also higher by around 1% on Tuesday morning.
Ed Ludlow, thank you so much. Morgan Stanley with also a pretty sobering view, saying that U.S. stocks need to fall even further despite this year's slump. Mike Wilson saying the current market, quote, does not price the risk of a recession, which is 15 to 20% lower, or roughly 3,000. The bear market will not be over until recession arrives, or the risk of one is extinguished. Kaylee Lyons joining us now for more. Kaylee.
Well, Lisa, apparently a 23% drop in the S&P 500 so far this year, and June isn't even over, is not enough to accurately price in the growth risks that this country and this market are facing. That's the thesis from Mike Wilson over at Morgan Stanley, who says stocks could drop another more than 700 points in the near term. And he's not alone in that. Goldman Sachs, Peter Oppenheimer over there, also said that only a mild recession is priced in at this point, which leaves the market vulnerable to a deterioration in expectations. All that said, Goldman still has a 4,300 target on the S&P 500 at year end. Morgan Stanley, Mike Wilson, has a 12-month target, so a little bit different, but he sees it at around 3,900. But Lisa, just look at where consensus is, 4617 on the index. That would imply about a 22% gain for the S&P 500. And you have the likes of John Stoltz over at Oppenheimer with a 5330 target, which require a 45% rally over the next 6 months. So the gap in the range within forecasts is huge. Obviously, a lot of it ultimately will likely come down to the earnings story. Right now, second quarter earnings expectations are only for about 4.2% growth in profits, widening back out in the back half of the year, but still below those COVID peak levels. And Bloomberg Intelligence points out that you are seeing forecast revisions trending downward for the S&P 500 for each quarter until 2023, Lisa.
Kaylee Lyons, thank you so much. Goldman Sachs also seeing U.S. stocks exposed to more downside risk, saying, quote, while there has been a considerably derating and some markets are trading below average valuations, pricing is more consistent with a mild recession than an average or deep recession, leaving them exposed to a further deterioration in expectations. Kaylee, as you were talking about earlier, joining us now, Invesco's Kevin Holt alongside Julie Beal of Kayne Anderson Rudnick, who is still with us. This has been an issue right now as we deal with the potential for recession. At what point, Julie, do you actually see the market pricing that in? Or do you have a price point for the S&P?
We don't have a price point for the S&P, but we're paying a lot of attention to valuation metrics, right? And in a true, proper, deep recession, we should be in single-digit forward earnings multiples, and we're not there yet. And, I think, too, it's understanding the strength and durability of the earnings within the S&P. You have some sectors that are very exposed to major earnings declines, your deep cyclicals, and your deep value cyclicals, which have seen a really strong rally in the market. So I think there are major pockets of exposure where you could see big declines going further. So I think it really pays to be very choosy. I think it's a great time for active management because a lot of the market movements have been broad brushstrokes. So you can really find some good businesses here.
Kevin, are people too pessimistic right now?
I don't think so. I think you have, the Fed increasing rates for the first time in a long time. You have the end of quantitative easing. And multiples are about, if you believe the earnings of the market right now, about 15.5 times earnings. So I kind of think with our first rate increase just behind us, I think it's going to be a tough summer. And I think rates are going to continue to move higher throughout the year. I think we're likely to have earnings disappointments in Q2, which are going to create more attractive entry points probably later in the year, either Q3 or Q4.
So where's the value right now?
Well, and I think it's kind of interesting. It's most of us haven't lived through an inflationary environment, and I don't think the 70s are really even indicative of what we're at, because the 70s was mainly oil. So you have to go back to the late 1940s to where we have pervasive inflation, not only in oil but in food and a number of different areas. So I do think we're in an inflationary cycle personally. I think it's going to be here for a sustained period. I think wage inflation is something that will probably be around for a few years. Some of the other issues, oil, I think, we've restrained supply. This is not the same oil industry we've had. Demand is going to go down in a recession, but oil prices like we had in 2020 or even, the $50 level we've had historically, I don't think is going to happen again in the near future because this is a much better run industry than it's been in the past.
This sounds like a pretty pessimistic recipe, and every guest that we've had on this morning has had a pretty negative view in terms of where we could potentially be traveling. But Julie, other people point to the fact that you're actually getting yield for the first time, actual real yield, and 8.5% coupons on certain junk bonds on average. At what point do you start to ratchet up returns expectations because of the increased risk?
Well, I think it just depends where you're looking within the risk tolerance and risk appetite. So, I think because it's been broad brushstrokes in terms of what's sold off, particularly, let's say, in the tech sector, not all tech businesses are the same. There are ones that have, slower growing but very durable earnings that are well protected even in a recession. You look at a business like Aspen Technology, which even in the glut of oil prices was still delivering solid earnings growth. Those are the types of businesses that I think really can help you weather through the storm and also allow you to participate in the upside when we get to a recovery. So if you're a slow-moving investor like us and you just want to know your businesses really well, those are the types of businesses we're looking at right now.
Meanwhile, Taylor basically pointing out how much big tech has sold off, and bull's gonna bull. Wedbush's Dan Ives still being bullish despite the recent volatility in big tech, writing, quote, "The street is already baking in a mild recession into current tech stocks, and the risk-reward setup is favorable for our top enterprise plays. We could make any argument under the sun, but Kevin, do you think that there is a bottom starting to come in here given the cash flows and given how much these really do have incredible market share?"
Yeah, and I think what we've seen throughout the year is, the first group that was shot was technology, and then financials, and then retail's had its issues. So I do think there's opportunities in tech. I do think a number of the stocks, much like 1999, that don't generate cash flow and don't generate returns on capital are not good investments. But I do think, and we've even added recently to some large cap tech names that have strong free cash flow yields higher than the market, great businesses, great moats. And I do think those type of businesses are going to be what you want to add in this tough period. And we're going to come out the other side of this eventually. And I do think there's going to be some great values being created, just like there is at this point. You just have to be very selective and very patient.
Yeah, and that's actually something that UBS Stuart Kaiser noted as well in a note, basically saying it feels far away this week, but better second half outcomes remain possible. Talking about for tech upside, we still see a tradable window as core inflation settles into a lower month-over-month run rate over the summer. Do you agree, Julie, that does seem like a likely trading period? I know you're not into trading, but do you think that there might be an entry point, maybe, is the way to phrase it?
Yeah, I think entry points are always something we're looking at, right? For us as longer-term investors, the declines that we've seen have actually been a nice breather. And it's sort of like a cleansing shower on these valuations because we had just gotten to a place that were completely unsustainable. What I would say about tech is that even good quality tech, you have to be a little bit choosy. And so do I want a lot of exposure to the U.S. consumer or let's say the ad market, which I don't think is nearly as strong going forward as it has been? Not really, no. Even though these are really powerful businesses in terms of their duopolies, monopolies, I still think I would rather choose a software business that's serving other enterprises or other business communities. I think they'll be more resilient than anything that's tied to the U.S. consumer.
Julie, thank you so much for being with us. Kevin Holt, we're sticking together for another at least 20 minutes, so sorry. Coming up, recession risks rising. Take a listen.
I was talking to Larry Summers this morning, and there's nothing inevitable about a recession.
That conversation's still ahead, and some people did not get the pessimistic tone, at least if you take a look at where stocks are trading, up more than 2% in the first 15 minutes of the open as people look to claw back some of the losses experienced last week. This is Bloomberg.
I was talking to Larry Summers this morning, and there's nothing inevitable about a recession.
Homebuilders keeping a close eye on surging mortgage rates. Lennar Chairman Stuart Miller saying, quote, the weight of a rapid doubling of interest rates together with price appreciation began to drive buyers in many markets to pause and reconsider. We began to see these effects after the end of the quarter. Bloomberg's Michael McKee and Taylor Riggs both joining us for the data to watch this week and the broader market ahead. Michael, what are you looking at?
Well, let's take a look at the impact of those higher rates. Bankrate already has a 30-year fixed mortgage average for the country at over 6%, that coming in this morning. But it's not the 10-year note that necessarily drives it. You got to look at the Fannie and Freddie commitment rates. 5.46 is what they will buy a mortgage at, and that's what's key to you getting a mortgage. And you can see the impact on the white lines in the background. That's existing home sales. And when rates go up, sales go down. That's what's happening. This week we get a number of numbers, including existing home sales at 10 o'clock today. They're expected to be down 3.7%, continuing their run lower. Mortgage applications on Wednesday, they popped up just a little bit, but not much. They've been going down as people pull out of the market. And then Friday, new home sales, they're expected to be marginally higher. But again, this is a declining market because it's the most interest rate sensitive. Now, the other thing that Lennar and the other home builders are worried about is what prices are. Do they price people out? Look at the solid lines. That's existing in new home sales going down. That's what's been happening. But look at the dotted lines. Those are the prices for existing home sales and for new homes. The median prices, they still keep going up, and that's what's feeding into inflation. Those have to turn around. The solid lines have to pull the dotted lines down in order for housing to stop contributing to the big inflation rise we've got.
Yeah, well, and Taylor, this goes to the home builders and the outlook for them at a time when there still is a lot of demand.
Spot on. I'm taking a little bit of a play out of Mike's playbook. Take a look at this terminal chart. I think Mike said it best, right? When rates go up, prices go down, new home sales go down, existing home sales go down, right? So that sort of the classic correlation here that we're looking at. Mike McKee knows this better than I do, but arguably maybe this is actually what the Fed wants, right? Trying to cool off maybe a little bit of an overheated market here. And so that sort of is the basic supply and demand dynamics here at work. Take a look at year to date, some of the price action here of what's been happening to some of these home builders. Really tough, right? As some of the sentiment has rolled over on the fact that prices have been rising. We've talked a lot about the lack of inventory, some of the lack of affordability underway. You're up anywhere from like 42 to 44% year to date. So well into correction, well into bear market territory for some of these individual stocks. I liked Lennar, of course, because they're coming out getting a little bit of a bounce today and saying that, well, maybe this is a bellwether for the group. Maybe things aren't as bad as we think about sentiment and finally being able to come back into that stock. Here's sort of a good key here, though, Lisa. Mike has been talking a lot about sort of the rising costs, the rising input costs. Lumber is coming down a little bit, and so what that means is, well, maybe some of the home furnishings are also coming down as maybe people aren't having to furnish some of those homes. But that could be good news when some of that high input costs like lumber are starting to roll over just a little bit.
Taylor, Mike, thank you both so much. Invesco's Kevin Holt still with us. Kevin, do you start to see opportunities when you see home builders beaten down to that degree and the fact that people still want to buy homes?
Yeah, I do think what's difficult right now from a stock perspective is we're fighting the fear of the unknown. And as I said, we just increased rates for the first time. So I think economic activity is going to slow, and it's going to slow probably over the next 3 to 4 quarters. So I think it's, ultimately valuation and risk return, but I think it's still too early. I think the housing market's been incredibly strong for a long period of time. And I think with some of these cyclical stocks, you have to be very choosy about what industries and how much demand elasticity there's going to be. And I think in housing, with rates going up like it has, I think housing is going to be in for a tough run for a bit.
Over the past decade, though, Kevin, a lot of the emphasis has been for shareholders, for some of these home builders to return capital, to be prudent, to not really develop as much as be profit generators. At what point does that become an attractive proposition at a time when you still have a dearth of homes relative to demand, at least according to many housing experts?
Yeah, and I think it's just going to be, I think the big thing to focus on right now is just how demand holds in there, because you're exactly right. It's a much better industry than it had been in the past. It doesn't have the boom bust cycles quite as much as it's had in the past, although it is, ultimately the demand of the consumer. and interest rates are, at 40-year highs in terms of housing affordability. So I do think we need to be cautious, but it is a good industry, and there'll be a time to own these stocks. The question is it in 2022, or is it more we need to wait for the economy to kind of weaken in 2023? We can build positions here.
Kevin, before we let you go, I do want to get your take just quickly here on what kinds of margin pressures you expect. Kevin, do you think that that's priced in, or do you think that that's going to be a real pressure over the next 6 months for equities?
I think it's going to be a real pressure. I think some of the food inflation that we're seeing with the war, Russia and Ukraine, they're going to see increasingly pressure on food prices as we get into the back half. I think oil prices, hopefully, I'm not sure they'll go much higher. I don't think they're going a lot lower in the near term, but hopefully those don't get a lot worse. But then you have wage inflation, which I mentioned, and we see continued pressure on wage inflation, and we still continue to have supply chain issues. As long as China has a zero tolerance policy with COVID, supply chain issues are going to be persistent. So the combination of those factors makes it very tough for the rest of 2022. But I do hope as we get in 23 and lap some of these issues, that creates opportunity, and then the markets can rebound.
Kevin Holt, thank you so much for being with us this morning. Coming up, the market moving events that you need to be watching. That's next in our trading diary as we try to claw back some of the losses from last week, up more than 2% just into the open. This is Bloomberg. This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Ferro. Just taking a quick look at markets, you can see the NASDAQ really leading the way, up 2.6% as people perhaps try to find value after last week's 6% losses. Time now for the trading diary, what you need to be watching this week. Existing home sales coming at the top of the hour, followed by Fed speak from Barkin and Mester. On Wednesday, Chair Powell heading to Capitol Hill for 2 days of testimony. Plus, we'll also hear from the Fed's Evans and Harker. Another round of jobless claims, and the Fed releasing the results from its stress test on Thursday. And finally, new home sales, Michigan's consumer sentiment survey, the key one for the Fed, at least according to them. And the Fed's Bullard and Daly speak on Friday. This was Countdown to the Open from New York. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, June 21st. Here are the top market stories that we're following for you at this hour. Place your recession bets. Biden doesn't think one is inevitable, while Elon Musk does. The odds of a recession this year and what it means for stocks. Breaking up is easy. Kellogg splits into 3 companies as it got too big to handle. Shares are off the highs of the session, up now by just 3.7%. And a few unresolved problems. Elon Musk continues to throw his Twitter takeover in doubt. More from our exclusive interview from the Qatar Economic Forum in Doha. From New York, I'm Alex Steele with my co-host Guy Johnson, who is in Doha today. Welcome everyone to Bloomberg Markets. Guy, you've had like a front row seat to the biggest names in business and economics. What's your takeaway so far? What are you guys talking about?
So we spent the weekend covering the airline sector and what was happening in aviation, Alex, at the IATA conference. Then we've moved over to the Qatar Economic Forum today. Look, there's lots going on. The conversation that you started at the top of the show about a recession, I think, is absolutely front and center. For the airline sector, it's how long does this demand hold up for? Everybody wants to go somewhere, anywhere this summer. But what happens after that? And are we starting to see high gas prices, etc., maybe downgrading people's optimism about their travel plans going forward? Then you just get into the wider macro story. We've been hearing from Elon Musk today, hearing from a whole sort of host of CEOs. They're all definitely hedging their bets at this point in time, but they are all preparing their businesses, it seems, for the possibility of an economic slowdown. I was talking to John Slattery over at GE. He was talking about the fact that if his business kind of does this, that's fine. If it then tapers off a little bit, that's great. But if it does this and then this, then they've hired a lot of people, and that's going to be a problem. So I think that does seem to be the sense right now, Alex. Everybody's just trying to sort of see what happens. Yes, they're expecting a slowdown. Maybe they're expecting a recession. The open question is, how severe will that recession be?
Yeah, Guy, and one particular indicator where we're going to see signs of those cracks is in the housing market. Lennar had some solid numbers, but the outlook really murky, and we just got May existing home sales. And a month-on-month basis, we're down by about 3.4%. And on a total number here, it's 5.41 million. That sounds good. In February, that number was 6.4. So we're down 1 million in terms of existing home sales in just the span of a few months. And we're going to delve into this topic later on in the show with John Ziegler, CEO of Rent, because as the housing market gets shaken up, that's going to mean potentially more renters, and that means even higher prices on your monthly bills. Let's get back to that point the Guy was just making in terms of the recessionary alarms that most businesses are starting to really think about. Investment banks kind of adding to that. Morgan Stanley, Goldman Sachs say equities have further to fall. Here's what some of the global leaders have said at the Qatar Economic Forum.
A recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not.
There's nothing inevitable about a recession.
We're not yet in a recession, but we're getting very close to it. My baseline is one of a hard landing.
Inflation's not going to cure itself, Francine. So seeing a cooling of the economy is something that we believe is appropriate.
Interest rate increases are likely to flow through to lower economic activity, and that's going to put pressure on budgets. And the equity markets are calling for that.
Which brings us to the question of the day. Do we get a recession this year? Let's bring the question to Bloomberg's international economics and policy correspondent Michael McKee and Romain Bostic of Bloomberg Markets, the co-host. All right, guys, let's weigh in. Mike, let's start with you on the economic front, then we'll get to the equity front. Recession this year, yes or no?
Yeah, I fall into the camp that they teach you in Economics 101. If you're going to make a forecast, give a point figure or a time frame, but don't give both. I don't think that people really know whether we're going to be in recession this year. Some think we're already in it. Others see the economy decelerating, and the Fed sees the economy accelerating a little bit from where it's been. Now, the problem is a lot of this has to do with COVID. Does something come back and shut us down again? A lot of it has to do with the war. Does that keep dragging on and keep weighing on prices for energy, which leads people to drive less, perhaps, and do a little bit less business? Most people's consensus is that it'll be next year, but it could be this year. Romain, from a market perspective, this is really important. If it's a 2022 recession, you want to position in one way. If maybe that recession comes late 2023, maybe earnings hold up for now. Maybe actually you want to position maybe a little bit more aggressively into that story. You've got a little bit of time before the recession really bites.
And I think you're already seeing that reflected in a lot of the expectations for earnings growth, at least here in 2022 and even into the early part of 2023. But those are analyst estimates. When you look at sort of what you're getting specifically out of the CEOs and CFOs themselves and what they're predicting, I think you are seeing at least a lot more concern about inflationary pressures and, of course, potential recessionary pressures. Overlay that in with the drawdown that we have right now in markets. At least as of Friday, we were down something like 23% on the S&P 500. And I'll tell you, just on a historical basis, and who knows if history repeats itself, but on a historical basis, we've never had that magnitude of a drawdown and a persistent drawdown of that nature that didn't accompany a recession.
Yeah, and Romain, it talks about many strategists are saying that we're not going to get a bottom in markets until we finally get the recession. I know this is a surprise for everyone, but Mike Wilson over Morgan Stanley is a little bit bearish.
Yeah,
he says that markets are fairly priced. However, it does not price the risk of a recession in our view, which is as much as 20% lower, or roughly 3,000. The bear market will not be over until recession arrives or the risk of one is extinguished, which just leads to the point, what sectors have more downside from that? I mean, energy really comes to mind.
Well, energy comes to mind, and a lot of the cyclical sectors, which you've seen under pressure. Look, there's already been a lot of talk that you have certain components of the market and the economy, for that matter, that are technically in recession. I mean, depending on how you measure it. Obviously, it doesn't meet the NBER's official designation of that, but when you look at real incomes, when you look at the shift in spending around certain sectors from goods to services and the idea that service is now showing weakness, there's an argument to be made that we're already there. The question is, do we sort of go over that precipice into a full-blown official economic recession, as Mike was alluding to, and just to kind of punch back at Mike too, he talks about kind of the imperfection of economic forecasting. We know that. I mean, Mike knows sort of the old quip from Paul Samuelson, the idea that economists have predicted 9 of the past 5 recessions. That's a great track record.
Absolutely. My question, though, Mike, is the Fed worried about a recession? Does the Fed actually want a recession? I was listening to Tidjane Thiam, the former Credit Suisse CEO, a little bit earlier on. He was talking about the fact that the Fed probably still has to shock the market and shock consumers, because what it's worried about is not just inflation, but inflation expectations. We're going to get the University of Michigan data out on Friday. If we're starting to embed the idea that further out we are still going to have elevated inflation, elevated north, Mike, of 2%, are we still in the business of having to think about the fact that the Fed may still need to shock us, that actually we may see even bigger hikes coming towards us, and that will accelerate this process towards a recession?
I think it's going to be a magnitude of change in the numbers that will drive what the Fed does. The Friday number from the Michigan survey is going to be a final number for the survey that already came out. So it might change a little bit. Powell said it could go down a little, probably not. But next month will be key, as will the CPI numbers for next month, before the Fed decides how far it's going to go. They don't really want to go 1%. They've already accepted the idea they may have to do 75 basis points again, but they don't want a recession, and they do fear it. They are going to try to be as careful as possible, but it is, as everybody says, a big blunt hammer, so it's hard for them to be that precise. And the problem is all the data are backward looking, so the Fed doesn't really know where it is at any particular point in time. There are some indications that inflation is going to be harder to correct than they had anticipated, including the fact that the war goes on. Housing prices today, the existing home sales median price went up, even though home sales have been going down, so that feeds into inflation. At some point, they're going to look for a turn in the prices that are being charged, and part of their problem with that, too, is COVID and the pandemic, and they don't know when all those things are going to start going away. So it's going to be tough for them to decide.
But, Mike, we talk about the persistence of this. Everyone keeps talking, does the Fed need to sort of shock and awe? You're looking at headline CPI right now has been basically running well above whatever 2% target you want to pin on it for something like 14, 15 months. Even core CPI has been running above that for 13 months, I think. And even if you look at the PCE deflator that, the Fed is supposedly prefers here, I think that's that's been running something above 4% now for something like almost 12 months now, if I'm right there. But the point is that this has been going on now for basically a year, and the idea that it will sort of ebb on its own, at least in a meaningful way, I don't see any real evidence of that. And there was another survey out when you talk about sentiment. It was the Conference Board survey, I think at the beginning of last week, of CEOs that showed CEO sentiment was at the lowest level that we've seen in quite some time. And there was some great data out by Lisa Shallot, who talked about that number that we had on that Conference Board data, I think it was at 42, that we haven't had a reading that low, once again, that didn't actually accompany a recession in some form or another.
But we haven't had a recession based on pandemic before, and that's the problem. The inflation rate started to go down last year, and then COVID came back, and it went back up again. And that's the problem for the Fed, is the things that have interrupted the supply chains, like COVID and like the war, they don't go away. They keep persisting, and everybody thinks they're going to end, but they haven't. And when they do, we'll see some ebbing, but yes, they're going to have to raise rates to bring overall inflation down. ...
This time things are different. Guys, thanks a lot. Good conversation. Bloomberg's Romaine Bostick and Michael McKee. Really appreciate your time. All right, coming up, it's more on our question of the day. Do we get a recession this year? The equity implication. Mona Mahajan, senior investment strategist at Edward Jones, will be joining us next. This is Bloomberg.
At the moment, the demand is very strong.
There is massive demand. If I could get more aircraft into the air, I'll be doing it tomorrow.
I think the demand will probably remain in place, probably for the next 18 months, 2 years.
We've got the upslope from continued COVID recovery.
There is a very, very deep need for flying, for traveling, that has been contained for 2 years.
Internationally, we're only at 50% of our pre-COVID levels, and demand is a lot greater than that.
You've got a situation here where people have built up savings, but you're also dealing with inflation rates that we haven't seen.
The aviation ecosystem is still, as you said, suffering from some of the same staffing challenges that we're seeing in other sectors too.
So the problem then is that you've got the demand which can't be serviced. Does that mean that demand is going away? Possibly, but not entirely.
But actually the outlook remains very, very positive.
Some of the aviation CEOs that I've been talking to over the last couple of days at the IATA annual general meeting, which has been taking place here in Doha, what they were talking about there was what they see going forward from here. Really strong demand right now, but the real question they're trying to figure out, and they're quite optimistic about it, they tend to be airline CEOs, is how sustainable is that after the summer? And that kind of feathers in really to our question of the day. Do we get a recession this year? And if so, what does it hit? Let's try and answer that question now in a different way. Mona Maharajan, Senior Investment Strategist at Edward Jones. Edward Jones, 1.7 trillion in client assets, joins us now. How would you answer that question? Because I think it's going to have a meaningful impact on the way that people invest if we get a recession this year, or whether it's a 2023 story or 2024 story.
Yeah, it's a great one. And, look, I think generally the timeline for a lot of not only recessionary calls, but even the Fed inflation have been pulled forward. So our base case had likely been, if we do get a downturn, it would hit sometime in 2023. Given just what's occurred in the last week and a half with the CPI print and then the Fed meeting last week, some of that timeline is pulled forward. The Fed is now moving 75, likely another 75, and probably another 50 and 50 after that. So keep in mind, these are unprecedented levels of Fed rate hiking. We haven't seen it probably in nearly 30 years. And so in that backdrop, markets are savvy. We know the history. The Fed doesn't have a great track record. Out of the last 14 tightening cycles, 11 had ended in a recession. And now we are in a tightening cycle that is moving quite a bit more aggressively. Yeah. So the risks of a downturn are increasing. Probably we're looking towards the end of this year. But the only silver lining, or one silver lining we'll point to, is that we don't yet see the scope for a deep or prolonged downturn. So in that backdrop, maybe what the market's already priced in, S&P down over 20%, NASDAQ down over 30%, we're already starting to sniff out this mild downturn in the economy. And so the risk reward is getting more interesting here for sure.
Mona, that dovetails with what Mike Wilson and Morgan Stanley have been talking about. We know he's a bear, right? But he's talking very much about the idea that you can't really know the bottom in equities until the recession actually starts, even if it's not a prolonged, deep, depressionary downturn, but that the bottom's going to keep on moving lower. Do you agree with that sentiment? And if so, are there sectors that have to price that in more versus those that have already priced that in?
Yeah, we have a slight nuanced version of that, which we say we won't really see a sustainable market rally or rebound until we see inflationary pressures consistently moving downward. So that's not going to be one print, probably not even two prints. We need to see 3, 4 consistent prints lower, and hopefully in both the headline and core part of inflation before we start to see, then that could trigger a Fed moving more gradually, and then that could trigger a more sustainable rebound in the overall market and economy. So we think that will be, the key going forward. When do we get that? How do we get that? And I think the Fed actions are certainly part of the demand part of that equation. To your point on how we can position ourselves, well, we think certainly in the near term, a little bit more of a defensive posture does continue to make sense here. We continue to like large cap over small cap. Even sectors like healthcare, like the staples part of the market, they have pricing power, a little bit of inflationary hedge, but of course in a downturn they hold up relatively well. Even parts of the investment grade bond market starting to, the risk reward there, as we noted, is quite interesting as well, and a little bit more defensively positioned. So for the near term, that's what we would see. Mona, forward though, that could change.
How different does that picture look if inflation remains elevated even in a downturn? There is this expectation that the downturn is going to pull inflation sharply lower. There is some historical precedent that doesn't always happen. What happens if inflation stays higher during this downturn? How does that affect the investment outlook?
Yeah, what you're pointing to there is probably one of our tail risk scenarios. Certainly not a base case, but it is essentially the stagflationary environment where inflation continues to run hot even as the Fed continues to move higher and higher. Essentially, that would impact the demand side and really have no impact on the supply side, and that really would be driving inflation higher as well. That is really probably one of the worst outcomes for markets broadly. That's when we would potentially see maybe a more prolonged downturn and harder to find places to hide in that environment. But certainly we would probably reconsider the commodity complex there as well. Interestingly, parts of growth can do well if inflation continues to run hotter as well. But generally, not as many places to hide, and probably you would want to become even more defensively positioned in parts of your portfolio as well.
Mona, we only have about 30 seconds left, but does cash become part of that?
I think generally if you're waiting for the economy to turn and inflation to turn, you could actually increase your cash balances until we start to see signs of that. But that is really if we start to see signs of the stagflation. Right now, our base case is for a mild downturn. Keep in mind, we started this year from a position of strength, so we do think a mild, not deep or prolonged recession, which is starting to get priced in. We don't think you need to raise much cash here, and in fact, start to look for opportunities over the next 12 months or so that could start to make sense. Rebalancing, diversification, key to portfolio right now.
Mona, January feels like so long ago. Thanks so much. It was good to catch up with you, Mona Mahajan, a senior investment strategist at Edward Jones. All right, coming up, we got Tesla shares are up after Elon Musk remarks at the Qatar Economic Forum in Doha. He gave a little bit more clarity on Tesla's workforce plans, and some of that interview is coming up next. This is Bloomberg.
So Elon Musk says Tesla intends to keep increasing its hourly workforce while the number of salaried staff ultimately will shrink, at least in the short term. Now, in an interview a little bit earlier on today with Bloomberg's editor-in-chief, John Micklethwaite, at the Qatar Economic Forum in Doha, Musk covered, well, a wide range of subjects when we had that conversation, including, of course, his acquisition of Twitter.
There are still a few unresolved matters. You've probably read about the question as to whether the number of fake and spam users on the system is less than 5% as Twitter claims, which I think is probably not most people's experience when using Twitter. So we're still awaiting resolution on that matter, and that is a very significant matter. We're awaiting resolution on that. And then, of course, there is the question of will the debt portion of the round come together, and then will the shareholders vote in favor? So I think those are the three things that stand in that needs to be resolved before the transaction can complete.
What about the general state of the economy? Does that weigh on you when you think about this? I mean, you just described it. You have a super bad feeling about the economy. Are you still in that position? I just said to you earlier, Joe Biden has just come out and said that a recession in America is not inevitable. How do you feel about the economy?
Well, I think a recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not. It certainly isn't. It's not a certainty, but it appears more likely than not.
Can you set the record straight on one thing, which is this issue about the layoffs? I think you said initially that Tesla 10% of the workforce would be cut, then 10% of salaried would be cut, then salaried would stay flat and overall headcount would go up. What is the number? I know there's already, I think, been a lawsuit about the 10%. Is 10% the goal to reduce the workforce, or what is the number that we should think about, or that you're planning?
Yes. So Tesla is reducing the salaried workforce by roughly 10% over the next probably 3 months or so. We expect to grow our hourly workforce. It's quite clear that we expect to grow our hourly workforce, but we grew very fast on the salaried side, and we grew a little too fast in some areas, and so it requires a reduction in the salaried workforce. And we're about 2/3 hourly and 1/3 salary. So I guess technically a 10% reduction in the salaried workforce is only roughly a 3.5% reduction in total headcount.
That was Tesla CEO Elon Musk speaking with Bloomberg editor-in-chief John Micklethwait from the Qatar Economic Forum in Doha. And just one of the companies that's kind of changing their workforce as we're headed into some kind of impact from the Fed hiking rates. He says definitely a recession at some point. President Biden has a little bit more flexibility, says it's not inevitable. Well, we'll take a look at one part of the economy that does seem to be under pressure, and that's the housing market. Sales of previously owned homes in the U.S. are falling for a fourth month in May. We're going to discuss what it means for the rental market with Rent CEO John Ziegler. That's coming up next on a day where the S&P is up by about 2.5 percentage points, right around those highs of the session. This is Bloomberg.
This is Bloomberg.
All right, we're an hour into the U.S. trading session. We're pretty much around the highs of the session. A big relief rally underway. Bloomberg's Abigail Doolittle is tracking some of those moves. Abigail?
Well, Alex, it's really pretty interesting. If we take a look at this 4-day chart of the S&P 500, we, of course, after the Fed chair, the FOMC meeting and Fed Chair Jay Powell spoke, we had a big rally for stocks. Here that is. And then we had 2 brutal down days. Well, now we are higher. The S&P 500 right now up about 2.5% on the session. So perhaps we're seeing a continuation of that rally provoked by the idea that Jay Powell was saying that don't get used to the idea of 75 BIP hikes. We don't know that yet, but there's a possibility of that. That sometimes happens after meetings. It's certainly supported. The possibility of it is supported by what we're seeing sector-wise. Lots of strength for sectors for the S&P 500. The energy sector on fire once again up 4.7%. The chips and the semi-cap equipment, which has been under so much pressure today, a nice rally up 3.6%. Banks up 2.6% and ahead of the Fed stress test on Thursday. The expectation that these big banks will be able to release a lot of dividends and buybacks. And then Tesla in a class of its own up 8.4%. Of course, we were just listening to an earlier interview with CEO Elon Musk talking about the workforce reduction. Investors seem to think that perhaps the worst is out of the way. So again, up 8.4%. Now, is the worst out of the way for the S&P 500? Now, this is a long-term technical chart. You can see that the S&P 500 does appear to have hit support that was found ahead of the big topping process, for lack of a better way to put it, holding in here. There's reason to think we are going to see some kind of bear market bounce up toward above 4,000, maybe still toward 4,300, certainly supported by the RSI. Let's see whether or not this develops. It has to come from a sentiment standpoint. One place that could come from is Bitcoin. There appears to be a capitulation bottom in place. The chart we're about to take a look at doesn't really show that capitulation, but capitulation is essentially a big move lower and then strong buying. We certainly have that if we take a look at this multi-day chart of Bitcoin. Down, down, down. Here's the buying. We want to see it continue higher right now, though, over this time period. Bitcoin down sharply. But, Guy, I would say Bitcoin right now technically confirmed to go back above $30,000 per Bitcoin, maybe even more.
Abigail, I interrupted you there. I apologize. Thank you very much indeed. Bloomberg's Abigail Doolittle. Let's move on from what we're seeing in terms of the technical charts to what we're seeing in terms of the housing market, one of the critical aspects of the U.S. economy that we really want to pay attention to. Existing home sales in the U.S. fell for a 4th straight month. That's May data we're talking about here. They dropped to the lowest level in almost 2 years. We're seeing mortgage rates surging. We're up circa 6% now. Alex Steele obviously called the bottom in that market, but let's see what it means for the housing market more broadly. Joining us now, John Ziegler, CEO of Rent, which is a leading digital marketing solutions company, which basically helps renters find homes. So we're talking about the rental market here. John, great to have you on the show. Really appreciate your time today. Let's talk about what is happening here. We are seeing yields rising really quite sharply in the bond market. That's rippling through into the mortgage market. How's that then rippling through into the rental market? What are you seeing right now?
Well, thanks for having me back. And what we're seeing is a continued strength in the rental market. We've seen a really strong run up over the last year. Rental rates year over year up for 1 and 2 bedroom apartments between 26 and 27% year over year. Now, what we have seen is really a slowing down of that increase. Since January, we've only seen rates go up across the market by about 2 to 3%. And in fact, we saw the first decline month over month in this past month, with 1 bedrooms declining by 0.3% month over month and 2 bedroom 0.4%. So we're starting to see a moderation in that. I think it's more just a fact of the vast increases we've seen already over the years, and then also now you're starting to see a weakening of the consumer.
We're looking at a chart here that tracks rents, and you're looking at 1-bedroom rental prices in New York up 46%. These are huge numbers. Long Beach, California up 62%. Where is the top? I mean, at some point people just cannot afford this.
Yeah, and that's what we were talking about. Really, those are year-over-year numbers, and those are really in the major markets that have increased the most. One thing to point out is that really in the Sun Belt and then some of the really larger cities like in New York City have seen massive increases year-over-year. We're starting to see those modulate as well. The other thing to note is that a lot of those increases are in the upper level, so the tier one properties. And so what we're going to see coming forward is a lot of inventory coming online. That'll be new inventory, typically going to be more expensive, and will bring those higher rents. And what that'll do is, as you look at the overall averages year over year, it'll continue to push those, even if in the middle tier they may stay more modulated or even begin to decrease as we see the impact of inflation on the consumer spend.
John, what kind of a gap do you currently see between rents and incomes?
We've actually seen, the amount up until last month, rents in terms of a percentage of income have stayed about the same. You've seen over the course of 2021 pretty significant income increases as well. And so rents really went along with that. But as we said, really the effective income is going to come down as we have inflation hitting people's pocketbooks much more. And so really it's more of a wait and see at this point, but we anticipate seeing that start to tip to the other side.
John, during the pandemic in 2020, we saw a lot of movement out of cities into places like Miami, Connecticut, New Jersey, for example, more suburban areas. Well, Miami is a different story, and I wonder if you still see that kind of trend in the rental market, or has that topped out?
We see that trend continuing, but what I'd say is people have also moved back into the major markets as well.